We begin with KPMG's chief economist and advisor to the Federal Reserve Board and regional reserve banks, Diane Swank, along with Jim Lacamp, Morgan Stanley Senior Vice President of Investments. Great to have you both, especially as these headlines are fast moving. Diane, the very latest Fed funds futures, and we should put those up right now. This is the very latest print. We are looking at a 70.9% chance. That's what the market is betting on a 25 basis point hike a week from tomorrow. What, if anything, have the last 100 hours changed regarding the calculus of the Fed's interest rate path?
Well, I think the biggest issue is that we've seen inflation at the core level. Core services inflation is starting to look sticky. This is one of the issues that the Fed has been trying to avoid. The risk is that we get a more corrosive bout of inflation entrenched in the economy. They don't want to do that because that would require even more rate hikes and a deeper recession. That said, a week ago, I would have said today's data, along with the employment data, would have given us a 0.5% hike. And basically, that's where Jay Powell was a week ago in front of Congress. What we're at now is, does the Fed pause as they look at financial market stability, or do they keep going? If they do pause, and I think it's a flip of a coin, if they do pause, it will be a hawkish pause. They will pause saying they are assessing the situation, but expecting to continue to raise rates, albeit not at a 0.5% at a meeting, which they were more than willing to put on the table just a week ago. It turns out a week is an eternity in the post-pandemic world.
Yeah, I would say, Jim, let's get you into the conversation here. Just as Diane said, inflation remains stubbornly high. If the Fed were poised for even a hawkish pause, as she puts it, wouldn't that spook the markets? I mean, what is Morgan looking for here? Because, you know, people I was talking to yesterday, experts were saying if the Fed pauses, that will really spook the markets because we know inflation is still very much in play. So they must know something is much worse than we do at this point when it comes to the banking situation.
Every time the stock market has decided that the Fed isn't going to be as hawkish as they thought they were, we've seen these rallies. And I think that is a big mistake. If you look at the history of bear markets going all the way back to World War II, bear markets don't recover, with one exception. That was 1990, 91. One exception. Otherwise, bear markets do not recover until you get a cut. That means you don't rally on the pause. You don't even rally on the pivot. You rally on the cut. And I don't think the Fed is in any position to cut at all. I agree with your other guests that inflation is stickier in many areas, in a lot of the areas that remain sticky. And now we're getting wage push inflation where workers are demanding more just to show up for work. So inflation is still a major issue. The Fed has to continue to address inflation. I think they'll raise 1/4 of a point. A few days ago, I would have said a half, but now I think it's 1/4 of a point. But I think investors need to be really careful about celebrating that, because that's the wrong time to celebrate. It would be premature in my view. And look, stocks are still at 17.5 times earnings. That is not the stuff of new bull markets. We need to get down to 12, 13, 14 times earnings for this market to really start recovering.
Well, exactly. And Diane, let's just put it this way. We're not out of the woods yet. It appears the ratings agencies have suddenly woke up. You know, some ratings agencies had Silicon Valley Bank up until its collapse at an A3 rating. That is a very respectable rating, 4 notches above investment grade. Now suddenly they've woken up. Moody's has cut its outlook on U.S. banking system to negative, citing a rapidly deteriorating environment. This afternoon, S&P Global placed First Republic on credit watch negative, says Credit Suisse, which is now a $2 and change stock. It's falling 1.7% right now. They say that Credit Suisse's 5-year credit default swaps, which for those of you who don't know what that is, they basically insure investors against a default of the company, have risen to a record 522 basis points. How worrisome are these developments, Diane?
Well, you know, I can't speculate on whether or not the financial crisis is behind us. Has the Fed contained it? And that's exactly why I think they might pause with this hawkish pause, because they need to assess the situation. And the bottom line is we just don't know. And I think that's the most important thing to remember. I do think what we do know is that we're going to see tighter credit market conditions for the backbone of the U.S. economy. And that is firms less than 250 employees have driven employment consistently since the reopening of the economy in 2020. They are playing an outsized role today with an acceleration in job gains since the start of the year. And those are the very firms that get money from the regional banks. And so we know that that credit market is going to tighten for them.
Exactly.
And that the Federal Reserve has to take that into account. And I think that's very important for the Fed to be thinking about in a pregnant pause, a hawkish pause, however you want to call it. I don't think the Fed is about to cut rates, but, you know, a week is an eternity, and we still got another week to go before that March meeting.
Can change. And guess what is changing? Folks, look at the lower right-hand bug. The Dow is losing steam very quickly. It is up just 22 points at the moment. Again, it had been up 487 at the session highs. Something's going on here. We are scraping all of the headlines for you. Jim Lacamp, you know, we've got these headlines out of Russia where a U.S. drone was downed by a Russian fighter jet. That in the past couple of hours. The market, amazingly, still has not broken down. Is it going to?
It's been very resilient. It's been amazingly resilient. But if you look at the markets, you look at the chart of the market, it's been hovering around the 200-day moving average ever since January, seemingly trying to figure out a direction. It appears to me that the ultimate direction will be lower. Now, historically, in the third year of a presidential cycle, March and April are very, very good. So we could continue to be resilient here. We're a little bit oversold from a standard deviation standpoint. We could be a little resilient here for the next month or two, but ultimately we've got a lot of problems to deal with. As Diane said, we've got loans that have kind of started to dry up. You look at senior loan officer surveys, and they say business has gotten, the standards are a lot tighter. You've got capital expenditure plans from businesses across the country that have really come down. And let's look at these banks. The funniest joke I heard over the last couple of days is that the taxpayers weren't going to pay for this. Who do they think their depositors are?
Well,
they're taxpayers, and it's going to flow through the fees. We're going to pay for it. That's going to also have an impact on the banks and lending. So it looks to me like we're heading for a recession. The yield curve is still inverted. That suggests to me that the next leg is down. I think it is down, probably retest the October lows, maybe a little higher than that. And then maybe September, October, we'll start to see some recovery.
All right, the Dow briefly turned negative. So this, as we said at the top, and we want our viewers to understand, this is why you have to stay with the final hour of trade. Things are very much in a state of flux. Diane, Jim, thank you very much.